Brad's asking a question that we've had many discussions before in 2020. How to use the market sentiment reading indicator on the home screen. Have you looked at using this as a basis for trading? Yes. I go long SPX when it's bullish and go short when it's bearish, or no trade when it's neutral. It's not necessarily no trade when it's neutral, Brad. And what I mean by that is that I'm not opening, I only have one married put right now too. I closed an AIG married put. We're doing the Starbucks position. I'm so sorry. The Starbucks position for the Fusion subscribers, Brad. Ernie's got 4 positions open right now, the married put positions. I mean, as far as the married put, I just have the one open. I have other positions open right now. When it's in a neutral, it was neutral yesterday, if I'm not mistaken. Let's take a look at the overall sentiment. I thought it went to neutral yesterday. Yeah, we've been in neutral for a while, but it was following the bearish sell warnings. Okay, so how do I use this for my trading? There's some other presentations that we have, Brad, I'll point you to in just a moment. But for now, let's just review. How would I trade this? When I start to see the sell warnings come up, it's really when I've seen 2 or 3 sell warnings in a row and 2 or 3 of these bearish sells appears. What I'm doing at that point is adding protective hedges to any bullish positions I might have in my portfolio right now, or easing up on the position size. In other words, Brad, in general, you've heard me, not you've heard me say, but many in attendance have heard me say, like a broken record, at any given time, probably somewhere around 50%, maybe 45 to 55% of my portfolio is in the protective married put positions following the rules in the blueprint. Around 15% is likely in bull put or bear put debit spreads now, depending on where the market stands, as we just referenced a little bit to Max's question on positions for SPY or SPX. 1 or 2%, 2 to 2.5% are in those strangles I mentioned. We'll just jot that down there. And I'll have maybe 10% in some calendar spreads, calendar calls or calendar puts. I've just found them harder to manage this year because of the quick movements, and you have to switch from bullish to bearish, and you have to do that with the vertical spreads too. The 45 to 55% in married puts I include some standard collars I might be using where the put's not as far out as it normally would be for a standard married put approach. And in addition to the SPY strangles, I may have 1 or 2% of my portfolio with some, I like to call lottery tickets, Brad. Buying maybe a straddle or strangle on earnings play, something that has earnings coming up in 5 or 6 days. I might buy a 10-day out straddle or strangle for an earnings position. And then I'll have 3 to 5% of my portfolio in a broad market hedge. Something along the lines of, as Sam was mentioning, maybe just shares of UVXY, maybe shares of TQQQ, whatever my portfolio is heavy in. Okay, so that's where I'm at. Let's say that I was in a bullish mode, Brad, and I've got married put positions open where I'm protected by the put option, low risk of 4, 5, or 6%. Let's say I do have some bull put credit spreads open and some calendar call spreads in those portions of my portfolio. When I start seeing this trigger on 812 and it says 816 again, I'm likely selling calls on my married put positions. Why? Because I'm going to get a max hedge here. We've been pushing up to these high values, 42.97, 42.80, 43.05, and so forth. And we see those sell warnings. And think of it as valves, right, Brad? It's, steam valves where all the pressure is built up and build up saying, open the valves, open the valves. Okay, let off the steam. And as the market pulls back, the steam lets off. Not a big move, but yeah, from 43.05 after the bearish sell warnings down to 41, and even before today, now we're down to 42, down to 41.28. Okay, it's about 200 points. It's about a 5% down, and then the big move today as well. But this went to neutral now because those have eased off. So here, what am I doing when these trigger? Brad, what I'm doing here is if I have profitable bull put credit spreads, meaning they're more than 50% profit and only a few days to go to expiration, I might be taking those off the table at that point, depending on how close expiration is. If it's triggered on the 16th and my expiration was the 19th, I might have still held on. But if my expiration on those puts was the 26th, but I had a profit on them at this point, I might be easing those off. I might add a put to my calendar call spreads in anticipation of maybe shifting to a calendar put if the market starts pulling back. Not necessarily closing the calendar call. But if I think I have too much exposure, too many contracts in one or two positions in the calendar call, I'm going to start lightening up the load on those bullish positions. Maybe sell half if it's profitable. Maybe sell 3/4, Brad, if it's profitable. When I start seeing 2 or 3 of those bearish sell warnings in a row, 3 or 4 bearish sell warnings in a row, absolutely. I'm keeping my hedge in place naturally, even though I'm lightening up on my bullish positions. And now I might consider opening some bear put debit spreads at this time, kind of shifting, even though I still have a couple bull puts open that may expire in a few days. I've lightened up the load, Brad, but I'm going to look maybe to start doing some bear put debit spreads and start planning to switch those positions, which would have worked out well. Not saying I would have switched from a calendar call to a calendar put. That's what I mentioned in Max's discussion, why it's harder to do, because I made a commitment to a good stock, and I thought the market was going to be stable to neutral, where that diagonal calendar spread would be very good. It's still maybe 3 or 4 months out. I might not have the profit that I want, but I made a commitment. I'm going to be in this for at least a few months, and now my sentiment has changed. So I do want to get out of the way of the freight train, don't get me wrong. But at the same time, it's much harder to close out of a calendar call or calendar put spread when the market direction shifts than it is potentially a vertical spread, such as a bull put credit, bear put debit, bear call credit, bull call debit. All right, so when the sell warnings appear, that's what I'm looking for. Now, we're neutral. Now, we think of neutral strategies. Is now a good time to open up an iron condor? Is now a good time to do a covered call, neutral to bullish strategy, an out of the money naked put, a good 10%, 20 to 30 out naked put with a 1-2% yield on the position? Not necessarily. And why I say that is because I want to know the events of what led up to this. The neutral was easing off because the valves were opening, the steam was being let off, some things that were showing bearish sell because they were at the peak of their fences of the different indicators. As it started to pull back, those eased off and went more to neutral now than the bearish warning. Okay, so now we're starting to ease off. We're starting to go back at this neutral field. But today was a big decline because of what happened. The market sentiment indicator alone doesn't guide my trading. But when I see a shift to those bearish sells or the bullish buys or the strong bullish buys, yes, I'm leaning into now might be the time that the market, when I start to see the bullish buys, Brad, excuse me, that might be telling me that, hey, we've now come close to hit a market bottom. Maybe it's now time to buy some of those 3 or 4 month out calls on quality stocks or stocks you are going to recover. Disney, Apple, Amazon. I don't want to say Tesla because who knows, but usually, yes, Tesla as well. IBM, boring stock, but it recovers. Walmart, those kind of things. That is a great time to maybe consider opening a calendar call spread, because when it starts going from the neutral, as it's going down, 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 it's been in a bearish turn, and you start to see the light bullish buys and the strong bullish buys. That's when you want to consider, hey, I'm going to open new married puts. I'm going to look to open some new calendar call spreads and take a chance. We're thinking we're near the market bottom, and that's the good time to go in. History, what have we got? You can see it here. Just the last strong, very bullish buys, when they happen, June, right when we hit the bottom, right? I know this is tough to read. This is SPX here. Look at when they started to scream bullish buy. When we're down at 3,700, 3,800, we went to the very bullish buys. Yep, that's when I opened the Starbucks married put, June 7th. Right there. It was more like right here when I started to see these bullish buys. But yes, June 7th, that's when I bought them. And what have we done since then? This one here was a little bit shorter term, but it was still a good time. We started to see these here. We went back up into that false little bear rally. But what did we see? We started to see the red warnings. Now, that was still neutral. Here, at the peak, down to here, what are we seeing? Exactly this. So where do I want to be positioned when this happens? I want to be getting income by selling calls somewhere around here against my married put positions. I want to be lightening up on my bull put credit spreads. I want to be maybe evaluating bear put debit spreads, or maybe consider calendar puts. But usually the bearish runs, as we know, are shorter than the bullish runs. This year has proved us wrong. They've been about equal. The bearish are still longer, actually, than the bullish runs have been. But that's how we use the tool. I have strategies I like, and I don't immediately shift to a completely different strategy, Brad, just because the market sentiment tool is at neutral, or it went to a strong buy, a very bullish buy, or a very bearish sell. What I look to do is manage the positions I have open that are longer term, lighten up the load on the positions and the exposure is the best term to use for it. I'm keeping that 2 to 3% of my portfolio, 3 to 5% of my portfolio that's in that broad market hedge. The inverse ETFs, contra ETFs, as Sam says, or shares of UVXY, VXX, or maybe calls on the VIX, which I'm really regretting I didn't do. I wanted to buy some the other day, but I didn't. I saw it was down to about 19 and it crept up to 20, and I thought it was a good time. Okay, no lamenting trading in that case. That's how, if you're doing covered calls, same thing. If you're in a covered call portfolio or out of the money naked puts, that's the bulk of your portfolio. Nothing wrong with that if that's your preferred situation, your preferred structure, Brad, excuse me. You start to see these sell warnings and those bearish sell warnings. What do you want to do? You might want to add a put to your covered calls to create a collar position. You might want to add a put to your naked puts or cash secured puts to create sort of a bull put credit spread. Or if I've got a naked put position and I see the sell warnings coming on, I might want to consider buying a slightly in the money put to convert my naked put to a bear put debit spread. Always a possibility to do that. It's an indication of an expectation of a movement is what we're looking for. And as you can see, yeah, some of these are not as drastic. This one was short-lived, but it hit the trigger right. It called the bottom pretty close to where 2 weeks later, a week later, we're back to bullish. And didn't really give us the bearish signal here, but when it hit this bottom again, yeah, it said, hey, expect for this. And then we started seeing these right here. And what did it tell us? Hey, expect for this. Now, it didn't expect for today's movements. The market sentiment tool can't predict what Powell's going to say. It can't predict, I hate to say it this way, but if someone decides to drop something they shouldn't drop on a country that, in my opinion, they shouldn't be in, that's beyond everyone's expectations, well, the market as a whole is going to have an effect. And the market sentiment tool can't pick up those outside events. But based on historic trends of what the 13 indicators have shown us, Brad, over time, that's what this is based on, where those fences occur. Let's take a look at a fence here. Is anything still bearish in this situation? I don't think so. Nope, no bearish. A couple bullish. So the VIX went bullish. And the SP, the MACD gap went bullish, but everything else is pretty much neutral. But let's just, I don't want to stick with the VIX, but I'm going to. Let's stick with the VIX. So what you look at here when you see the details, Brad, if you haven't come across a video that described this before, this is a histogram of the distribution of ending values for the VIX, the volatility index, since 2008. And it is skewed recently. I mean, having recent discussions with new options investors and trying to tell them about what 2016 and 2017 was like when the average value of the VIX was 9. And it stayed that way for months and months. There was no volatility. They just can't believe it. You know, from what they've seen, started trading in the last 2 or 3 years, they can't believe VIX has ever been that low. But again, this is the rough distribution. And what we're able to do is set fences on the position, meaning that if the VIX drops below 13, very rarely does it continue to go down in that level. So what does that tell you since it's inverse? Well, if VIX is down at 13 or down at 12, it's probably going to be a bearish indicator because the VIX has a tendency over time to revert back to the higher prices of 14, 15, 16. And if the VIX is going up, that means the market's coming down. At the same token, where we are right now, essentially 25.56, that's why it slipped into bullish. If it goes above 26 or 27, you very rarely see it. Now we have, March 20th, 2020, VIX was at 66. By the way, March 20th, 2020, straight for 4 days, 5 days straight, very bullish buy signals. That 326 is when Ernie started buying leap calls out to 2021 for Home Depot, Disney, Apple, things like stocks I mentioned. I was buying leaps on Starbucks, I believe, and some other positions. I forget which ones I bought. At first, just to buy the calls, thinking the market recovery because it was the strongest, very bullish buy that we have ever seen come up. Didn't expect the market to move as much as it did. Things were a little bit more expensive because volatility was higher, but open new married puts, buy long calls for the potential for profit or for the potential to turn them into calendar call spreads, diagonal call spreads, Brad, later on as well. But that's how each sentiment of the 13 works. Those fences are set because once you hit a value, you know that, hey, it very rarely over time goes to here. It's got to revert back. And if it reverts back, that means the market's moving up. I'm not saying the market's going to be up on Monday. I'm not going to say that Monday or Tuesday, the retail investors or the institutions are going to be calmed after we've had 2 days to think about it, a little bit of coffee, out in the park, maybe a little bit of wine in the evening, around a fire if it's nice enough and not too hot where you are. But I don't know if they're going to be calm enough after this weekend. We might still see downward movement Monday, Tuesday, and even Wednesday. But eventually, what do I expect? Maybe in 5 or 6 days or so from now, the market again maybe shakes off the comments from today. Maybe not, but they do. And we'll see this maybe start going to light buy, bullish buy, very bullish buy in that case. If it falls Monday or Tuesday, you're going to start seeing 4 or 5 bulls here and probably 5 or 6 neutrals. Somewhere around those lines. Hey, check me. We'll check it. But that's how I use the market sentiment indicator. If I get into a very bearish sell warning, Brad, or a very bullish buy warning, yeah, I might start loading up on new strategies, buying calls, buying puts, doing bear put debits in anticipation of that. But most of the time, I'm managing, hedging, protecting, or looking to increase returns on the positions I'm already in, the calendar spreads, a calendar put, calendar call, my married put positions, lightening up on the bear sells with my bull puts, or maybe opening some new bull puts if I start to see the very bullish buy segments. And like I've said, is now neutral. I'd wait for Monday or Tuesday. I can't give direct trading advice, Brad, but I'd wait to see what the action is on Monday and Tuesday. And if it stabilizes a little bit, I think you might want to consider something Sam mentioned and something I mentioned, maybe a straddle or strangle on SPY or QQQ that's maybe 2 months out, 3 months out, or 4 months out in that case, because you know you're going to expect to swing one direction or the other after now some easing has happened. At least that's what the last 8.5, 9 months have been telling us. Okay. Max says, all very interesting and clear. Great. I'm using the market sentiment that's tool the same way. It's been working fantastic for me. Well, thank you for that clarification, Max. Okay. Just another thought there. Sam says, I've built my Apple position. I have over 2,000 shares in Apple over the years. I've sold 180 calls from last week. We'll buy back on Monday. Yes, I think it was down to 171 or 172. There's some other discussion here, Brad. There's some help videos here. I don't know which one this is. It's 19 minutes long. Let me write that down. That's from 2013. I'm going to replace that sometime. Let me write this down too, Brad. Replace help video, because we have better ones. And this one I think was pretty fair, but without a little bit more historical view. But let's head on over to PowerOptions. And I want to search my videos just for, and you can do this too later on if you want some further insight. Market sentiment. So from 3 months ago, there's a current look at the market sentiment. Here's a review from 1 year ago. Quick review of the market sentiment, essentially 9 minutes of how we use how the indicators are selected, how we use it, and look at some bearish and bullish sentiments. June 17th, that's 21 minutes. That's a little bit more directed. Quick review, 12 minutes, that's a good one. Concepts of the market sentiment tool. I think this is the one I really liked. For gauging sentiment in the overall market, tool looks at 13. So it introduces it, goes through some of the indicators. There's other ones here that go through individual indicators and more. Yeah, this one was good. August 21st, 2020. It was a bit longer. Oh, sorry, that's the shorter one, 925. But we look a little bit at history like we did today, Brad. So that might give you some insight. So I think I'm going to check one of those three. The 9-minute one to look at the market, same though it's a year old, that one. And maybe I'll just use this one, but I wasn't as clear as this one, wasn't as crisp on this one. And maybe this one from 2 months ago, June 17th, 2020. That's when we started to see those, after we started to see those bullish buys. But to replace that help video one there that was a little bit older, you know, maybe it's not that old. Maybe I was just looking at history. Nope. August 30th, 2013. I need an updated one in that help video, that's for sure. All right. Anyway, Brad, sorry about that. I was babbling on a little bit, but there we go. That's the market sentiment tool. That's how we use it. Not, yes, sometimes I will get into a whole noon and say, hey, ooh, bullish buys. Let me take some flyers on some long calls. Ooh, very bearish sells. Let me take some flyers on some puts here on some high beta stocks, something like that. But again, a lot of it is you already have positions open, whether you've got 10 or 15 covered calls, 5 naked puts, whatever you have. When you start, if you're in a neutral to bullish position, you start see those bearish sells. Brad, you want to start consider hedging those, maybe lightening up, adding protection, converting to a collar or a different type of spread, or maybe adding some portfolio insurance. Again, buying puts on SPY, QQQ, shares outright of the inverse ETFs or VIX or volatility ETFs, excuse me,